David Mercer, CEO of LMAX Exchange. David, welcome. You exist in quite an interesting space at the moment in terms of industry segment, the platforms. There's a lot of M&A activity out there. I mean, what do you think, what's your observations on that activity and how do you view the landscape?
It is interesting. I think we're the last independent FX venue. And I think there's a place for that. Mm-hmm. You know, we've grown more than everyone else in the last few years. This year we're up 20% in terms of volume terms. Everyone else seems to be down. I think people are looking for another outlet. And you're seeing consolidation of previously competing venues. So I think that's interesting. Also makes it challenging, don't get me wrong. They have scale, I don't have scale. Yep. So that's the good bit. And then I look at the business model. I'm not sure any of those acquisitions have worked. So I'm not going to give necessarily my competitors a name check here, but a great deal was the big Chicago deal. Mm-hmm. That's clearly a market data deal. Yep. That makes sense. The one that's being talked about right now with the LSE is again a market data deal. Yep. A great deal, they have lots of it, and they have recurring revenues. The deals that don't seem to have worked for me are the institutional transactional platforms. So the smaller one in Chicago, yep, loss-making ever since. You can see that in the accounts. The one in Paris, mm-hmm, loss-making ever since, because they don't have those recurring market data revenues, and they have declining institutional transactional revenues. So it doesn't always follow when you buy these independents and put them in a bigger shop that 1 + 1 is going to equal 3. Sometimes 1 + 1 is equal 1.5. So it's very interesting. I think there's still a place for us. And we have to see if anyone can make a success of those acquisitions that have happened so far.
I mean, do you sort of look at it in terms of, I mean, can a business actually A, grow, and B, even exist on just transactional volumes in this day and age?
In the institutional segment, I would say that's very difficult. You know, we're at this show today. Banks, non-banks, they want to pay a couple of bucks a million. Yeah. You have to do a lot of millions for that to pay your bills. Yeah. So the beauty of LMAX Exchange Group is that I think we're unique in that we target all segments of the market. So everyone from retail brokers all the way through to asset managers, albeit via bank algo desks, we target those segments. So, and in addition to that, you have valuable market data. My job is to actually produce that value and get people to pay more for it. But I have valuable firm streamed limit orders as market data. So I think we're well positioned. I think the guys that are operating only in that bank and non-bank space, getting paid $1 or $2 a million, it's very hard, especially when you go into the overhead you're going to get through a large exchange group in Chicago or New York or Paris.
And the fact is, I mean, if you look at the history of markets, the first thing that gets crushed is brokerage. I mean, that's the easy competition, isn't it? The low-hanging fruit of competition.
That's the deals that are being talked about at the moment. They're almost saying, let's make that a loss leader. Yeah. And if you just look at the LSE results, I mean, a tiny percentage, I mean, less than 10% is transactional. You know, 40% is out and out market data. So I can see if people have bought these venues for transactional revenue, I can see them closing them. I can honestly see that happening because the cost of running it is prohibitive.
Do you think it's a question of closing it or actually saying, okay, we need to go somewhere else other than spot? And do you expect a big push into the other product sets?
Yeah, they have to. I have to, and certainly they have to, for sure, because spot FX, it's a bit like, you've seen it on the clearing side, in the PB business. No one wants to be in it anymore because they're not getting paid to take that risk. Yeah. And
well, there's also the question of how much money it actually costs to keep the risk technology up to date on those for that
correct.
Business.
And I'm lucky, I mean, in that, you know, we are 99.5% management owned, and we have the same tech stack that we've built it all ourselves. But I can be agile, nimble. I rewrite a third of my code every year. If I'm working in one of these huge multi-billion-dollar exchanges, I'm not sure I can transition the tech stack as quickly. And therefore, the cost can be triple, quadruple. Plus, remember their reputation, you know, they need to have dual matching engines, need to have backups for everything. They can't be as agile as the likes of us. So I think they need to find another way of making money. You know, I said, look, the two biggest players, I'm going to say the market data plays, the multi-billion-dollar deals that have been done are good deals, and they have good annual recurring revenues, mostly through market data. They're good businesses. The transactional ones, frankly, I worry about them. And what's going to happen? Let's just say they're moving to NDFs or forwards. Why are they doing that? Because people pay more for it. Well, they do more today. I mean, let's face facts.
How long does that last?
Correct.
Yeah.
Right? I mean, I would have laughed at you when I took over, bought LMAX in 2012. I would have laughed at you if you said that a bank would literally look me in the eye and say, I want to print for $1 a million. I would have laughed at you. But that's what they expect now. Back then you were quoting 5, 6, 7, 8. People seemed happy with it. Likewise, spreads were a pip wide or half a pip wide, worst case. Now they're 0.2, 0.3. So the whole dynamic's changing. So what's going to happen, a bit like in things like the crypto world, NDF world, forwards world, swap world, you still have margin, which is this wide. So spreads are that wide, com can be that wide, but over time, it's going to come down to the same level.
So then how do you respond to that as LMAX Exchange? Because it will be an issue for you as well.
It is an issue. We have to be the most efficient in the market. I think I'm the most efficient in the market. I mean, talking about boring stuff like profit and loss, not your publication, but my bottom line, my EBITDA growth is 50, 60% a year for the last 4 years, right? So 2017, I made $8 million. 2018, I made $20 million. 2019, I'll make $30 million, right? So that's an efficiency of the business model. Whilst I'll still invest in the tech, 70% of my spend every year is in technology. So I just have to be efficient. I have to be efficient in terms of the service offering, and with that comes an efficiency of the business offering. Otherwise, if you imagine what percentage of an exchange business is foreign exchange, of these big deals we've talked about, they might just look at it and go, why are we losing money there? What are our byproducts? Am I getting more business on the equity side? Am I getting more business on the future side? If the answer is not yes, they'll just delete it. So for me, as long as I'm efficient, right? As long as I can provide the service and bring more clients on board, still, what I'm doing volume-wise, so there's still a big piece of the pie to play for me. Keep that efficiency, and then I think potentially we can win.